Hello and welcome back to our channel. Hope you all are doing well. Let us continue with Accounting Standard 10 Property, Plant and Equipment. And in this video, we will be studying about part 4, that is impairment, derecognition and some other matters. So without wasting further time, let's get right into it. Now the first thing to learn is impairment. To understand impairment, we need to learn two terms, that is carrying amount and recoverable amount. Now carrying amount is that amount that is recorded in the balance sheet. The value for an asset which is recorded in the balance sheet is known as carrying amount, whereas the recoverable amount is that amount that can be got for the asset by selling it. Now impairment will occur when carrying amount is greater than its recoverable amount. So let us take an example. Let's say carrying amount of the asset is 5 lakh rupees and the recoverable amount, that is the value you get by selling that asset in the market, is only 4,50,000 rupees. So in that case, the value written in the balance sheet, the amount, is greater than its recoverable amount. Therefore, there is an impairment loss to the extent of 50,000 rupees. And this impairment loss is accounted and treated as per AS 28, which deals with impairment of assets. So there can be a simple formula derived from here, and that is impairment loss is equal to carrying amount minus recoverable amount. Then moving forward, what is derecognition? Let us see. The carrying amount of an item of property, plant and equipment shall be derecognized, that is eliminated from the balance sheet, in either of the two situations. One is on disposal. Now disposal means selling of the asset, or if there are no buyers for that asset, then abandoning that asset, which means throwing it off or donating it. That is known as disposal. That is one way of eliminating it from the balance sheet. Or when no future economic benefits are expected to be realized from that asset, in that case too, the asset will be derecognized, that is eliminated from the balance sheet. Now, there is one more concept in derecognition, and that is derecognition of a replaced part. Let us see what that is. If an enterprise had recognized the cost of a replacement for part of a PPE item, it should derecognize the carrying amount of the replaced part. Let us see with an example what is the meaning of this concept. Let's say an organization had acquired an aircraft, but while recognizing, it has recognized the body of the airplane separately, that is the airframe, and the engine was recognized separately. Now this may be because they have a separate useful life, so it is necessary to account for them separately. Now it is time for replacing the engine. The engine has been used completely and there is no benefit to be received from that engine. So what will happen is, it is time to derecognize the engine. Now that is only a part of the entire aircraft. So what will happen is, you may derecognize only a part of the asset instead of derecognizing the entire asset. So in this case, only the engine will be derecognized. Now, a replaced part may not be a part that was depreciated separately. There is no necessary condition that a replaced part should be derecognized only if it was depreciated separately earlier. It can be derecognized even if it is not depreciated separately from the rest of the property, plant and equipment. Then, if it is not practicable for an enterprise to determine the carrying amount of the replaced part, it may use the cost of the replacement as an indication of what the cost of the replaced part was at the time it was acquired or constructed. Now taking the same example, it is time to derecognize the engine. But what if you don't know what was the cost of that engine? Then what will be done is, in the present year, that is in 2020, the cost of this engine, for simplicity's sake, let's say it is rupees 5 lakhs. The engine cost in 2020 is rupees 5 lakhs. Now you need to derecognize this engine, but what was its cost earlier? Let's say it was purchased, this entire aircraft was purchased in 2010. Then what was its cost in 2010? If you cannot estimate what was its cost, then the best estimate will be done in the following manner. Whatever is the replacement cost in 2020, that is 5 lakh rupees, is the cost in 2020. An appropriate discounting rate will be used, and what will be done is that discounting rate will give us what was the value of this engine in 2010, that is 10 years ago. So this 5 lakhs will definitely be costing less in 2010. Now that cost will be estimated using an appropriate discounting factor. Then moving forward, we have accounting for changes in existing decommissioning, restoration and other liabilities. Now in earlier videos we had studied that on initial recognition of an asset, even liabilities for decommissioning or restoration or dismantling the asset have to be added to the cost at initial recognition itself. But at initial recognition, only an estimate of those liabilities could have been made. Later in future years, the liability has changed. Then in those circumstances, what should be done in the books of accounts? Let us have a look. Cost of a PPE may undergo changes subsequent to its acquisition or construction on account of changes in liabilities, price adjustments, changes in duties, changes in initial estimates of amounts provided for dismantling, removing, restoration and similar factors and included in the cost of the asset. Then upon such subsequent changes in those liabilities, the treatment may be done as per any one of the two models, that is as per the cost model or the revaluation model. Then under the cost model, what is the treatment? Let us have a look. There can be three situations and the treatment of each situation is listed here. What we will do is take each situation and understand its treatment through the help of an example. Let us see. Treatment under the cost model, the first situation is there is an increase in liability. Then what should be done? The treatment is the liability, whatever was increased, should be added to the cost of the related asset. Now here in the current situation, you have carrying amount of the equipment as 12 lakh rupees and there is an increase in liability to the extent of 3 lakh rupees. Then the accounting to be done is increase the cost of the asset by increase in liability, and that is 3 lakh rupees. So the new carrying amount of the asset will be 12 lakhs plus 3 lakhs, and that is 15 lakh rupees. Then decrease in liability but not exceeding its carrying amount. Then the treatment is deducted from the cost of the related asset. So again, taking an example, current carrying amount of the equipment is 2 lakh rupees. So if you see in the balance sheet on the asset side, equipment is stated at 2 lakh rupees and there is a decrease in liability of 50,000 rupees. Then what should be done is it should be deducted from the cost of the asset. So 2 lakhs minus 50,000, the new carrying amount will be 1 lakh 50,000. And there can be a third situation wherein there is decrease in liability but exceeding its carrying amount. The decrease in liability is to such an extent that it is exceeding the carrying amount. Then the treatment is up to the cost. It should be deducted from the cost of the asset, and beyond that, excess should be recognized in profit and loss account. Let us see. The cost of the equipment currently is 40,000 rupees and there is a decrease in liability to the extent of 50,000 rupees, which is exceeding the carrying amount of 40,000. Then in that case, entire 40,000 will be written off from the balance sheet. That is, the equipment will be written off. It will become nil, and the remaining 10,000 will be recognized in profit and loss account as 10,000 rupees. The decrease in liability, remember, is a gain because in future we have to pay less amount. So therefore the gain due to decrease in liability is 10,000 rupees, which should be credited to profit and loss account. So the entire decrease in liability of 50,000 is accounted as writing of the equipment to the extent of cost, that was 40,000, and the excess 10,000 is recognized in profit and loss account. This was the treatment as per the cost model. There can be also a revaluation model for treatment of changes in liability. Let us see. In this case, there are 4 situations. Let us see each situation again with the help of an example. Now treatment under revaluation model, the first situation is decrease in liability, but the asset was not previously revalued. Then in that case, whatever is the decrease in liability, it is a gain, it should be credited to revaluation reserve. Let us see. Current carrying amount of the equipment is 10 lakh rupees and there is a decrease in liability of 2 lakh rupees. Then if you see, the equipment currently is stated at the carrying amount of 10 lakhs and there is a decrease in liability to the extent of 2 lakhs. The new carrying amount of the asset will be 10 lakhs minus 2 lakhs, that is 8 lakh rupees. And the second effect, the decrease in liability will be credited to revaluation reserve and that is 2 lakh rupees. Then the next situation is decrease in liability of an asset which was previously revalued downwards. Then in that case, the treatment is to the extent of revaluation deficit recognized in profit and loss account and the excess is increase in revaluation reserve. So example, carrying amount of the equipment is currently 5 lakh rupees which is shown in the balance sheet and there is a decrease in liability of 2 lakh rupees. But remember, this asset, the equipment, was revalued downwards earlier. So if you see, a profit and loss account shows a debit of revaluation loss to the extent of 50,000 rupees. This is the present scenario and the decrease in liability is now 2 lakh rupees. So how do we account for that 2 lakh rupees? The new carrying amount of the equipment is going to change and that will become 3 lakh rupees. That is 5 lakhs minus 2 lakhs, that was the decrease. So the carrying amount has become 3 lakhs. Now this 2 lakhs that was decrease in liability, how should it be accounted for? The treatment says to the extent of revaluation deficit is recognized in profit and loss account. So whatever was the revaluation loss earlier which was debited now should be negated by giving a corresponding credit effect in profit and loss account and that will be gain due to decrease in liability to the extent of 50,000 rupees. But remember, decrease in liability is 2 lakh rupees out of which only 50,000 has been accounted for. The remaining 1 lakh 50 is to be increased in revaluation reserve. So revaluation reserve will be 1 lakh 50,000 rupees. Then the next situation is increase in liability but the asset was not previously revalued. Let us have a look. The treatment says whatever is the increase in liability should be recognized in profit and loss account. So the carrying amount of the equipment is presently 5 lakhs and there is an increase in liability to the extent of 20,000 rupees. So therefore the new carrying amount is going to be 5 lakh plus 20,000, that is 5 lakh 20,000. What about the 20,000 increase in liability? That will be debited directly to profit and loss account as loss due to increase in liability, that is 20,000 rupees. So this was increase in liability and the asset was not previously revalued. Then the next situation is increase in liability but the asset was previously revalued upwards. Then in that case, what is the treatment? To the extent of revaluation surplus, it is debited to revaluation reserve and the excess, if any, is recognized in profit and loss account. Let us see. Carrying amount of the equipment is presently 50,000 rupees and since it was previously revalued upwards, there is some balance in revaluation reserve and that is 3,000 rupees. And increase in liability now is 10,000 rupees. So how do we account for this 10,000 rupees? Firstly, the equipment's new carrying amount is going to be increased by 10,000 rupees. So the new carrying amount is 60,000 rupees. Now this increase in liability of 10,000, how should it be accounted for? The first part says to the extent of revaluation surplus, debit revaluation reserve. So if you see, there is some surplus in revaluation reserve and that is 3,000. So this entire 3,000 will be debited and the balance in revaluation reserve will become nil. But out of 10,000, we have only accounted for 3,000. The remaining should be debited to profit and loss account as loss due to increase in liability and that is 7,000 rupees. So entirely the amount of 10,000 has been recorded now. Firstly, by debiting revaluation reserve to the extent of the balance, that was 3,000. And out of 10,000, if 3,000 is accounted, the remaining 7,000 should be debited to profit and loss account. So this was the treatment for increase or decrease in liability due to decommissioning, restoration, etc. And both the models we have seen here, that is the cost model and the revaluation model. So these were the matters for impairment, derecognition, and of course for accounting the changes in liabilities. In case you have any doubts or queries in this lecture, you can directly contact on any of these two numbers. And in case you have found this video useful, please like and share our video as well as subscribe to our channel. Thank you.